Well, it's always fascinating to find out what our next guest is watching. He's always got a few particularly interesting stock names up his sleeve. Let's join Michael Frazis in the studio.
Hi guys.
Thanks very much as always for coming in.
Yeah, it's a pleasure.
So we've seen huge moves in tech stocks overnight, and we've seen a lot of moves predominantly put down to the day traders in the market for what is resulting in huge volatility in intraday moves. Are there any stock names in the local market that you're saying that are also looking to either take advantage or really reflect on what we're seeing in global markets?
You're right. It did seem a bit of a regime shift last night. Yeah. The stocks that were doing the best obviously did the worst at the end on huge volumes as well. And often you see those at reversals, not always reversals, but sometimes. There's definitely something you have to watch very, very closely. In the local market, we're looking at a stock called Selfwealth. Yeah. It's basically a discount broker that has got kind of the two things that we look for everywhere, which is intense customer love and exponential growth. This is a company that basically has twice as many accounts now as it did 3 months ago. You get excited when companies double every year. These people double over 3 months. The way they've been able to do that is they basically offer a flat discount rate of $9.50, which is vastly cheaper than everybody else in the market. And because it's still a small part of the market, they've got maybe 4 or 5% market share. It's very hard for people to compete with that.
In terms of growth, though, for this business, I'm interested because obviously it's mainly Australia-based. I know the company's expecting to provide an update on its US equity trading platform later in the year, a launch there. Do you think it could have success in a country like the United States?
Well, I think they'll definitely have international trading for Australian people. I'm not sure if they're actually going to the United States to try to get their customers.
Yeah.
But again, that's one of those things. It's so expensive for retail people to trade international stocks. There's so much obviously interest to buy, the Teslas, Apples, Amazons. If these people can offer it for $9.50, that's a really compelling offering. So basically what's happening, if you think about the churn, so the net new customers and the people that are changing accounts, Selfwealth is picking up about 20-25% of them. So they'll very quickly grow their market share at this rate. Another interesting stat is that of the people in Selfwealth, the stock is one of the top holdings. So the people that know it best are all buying the stock.
Yeah, well, that's not too bad for the company.
Buying the stock, buying the market. But is that the kind of exuberance that could leave some investors potentially caught out short when we're seeing these huge intraday moves? Some people are going to be buying the top, finding themselves 10-20% behind in local names here by the end of the day. Yeah,
it has doubled over the last few months. So obviously, markets are 2 steps forward, 1 step back at the best of times. So you just have to be very cautious when things have done that. They're truly doing something different. This market needs that. Look at the success that Robinhood had in the United States. It was a huge phenomenon, cultural phenomenon.
Well, on that phenomenon, the Robinhood traders, and we've seen, obviously that's what's helped boost Selfwealth over the last couple of months. Do you see that continuing? Is that a short-term momentum sort of for these stocks right now, or do you see this becoming a longer-term sort of trend?
I'd say it's a longer-term trend. Really? And I'd say that all the new people, the young people that come to the market, they're going to want a cheaper discount brokerage. So when you look at the offering, you can spend a fortune on these other companies or less on Selfwealth. You're going to pick Selfwealth. The other interesting thing is, unlike Robinhood does some things that are not quite right. They offer a lot of leverage. They let you trade options. You saw the suicide of a trader who was shown the wrong statement about account and got very stressed out about it. Selfwealth doesn't do that. These are buy and hold investors. They don't do margin lending. They don't do options. So there's a good chance that long-term retail holders will actually capture the uplift of the market. And will make money. And I think that's the right approach, the most responsible approach too.
Do you see some of the other bigger brokers potentially just simply trying to compete by lowering some of their prices? Will that be enough to stop the momentum that Selfwealth has shown until now?
Yeah, well, this is the challenge. If you think about, let's say, a Commsec and you're making a small fortune by charging $9.95 plus, a scaling increase of the fraction of the trade. For them to compete with Selfwealth, they're going to have to slash their revenue in half, probably by a lot more than half. But certainly at least half. Why would they do that? It's very difficult to do. And that's why somebody can come in and capture a small but real part of the market. And that's kind of what Selfwealth is doing. So it'll be very hard for them to compete. Because to compete, they'll have to cut prices on all their customers.
Can we talk a bit about the innovators as well? Because I know you've got a note out, in terms of your July update, talking about the innovators generating, outsized returns. When you look at things like Afterpay, we look at the buy now, pay later space, just absolutely exploding. You've got to be stock specific though. A rising tide is lifting all boats at the moment, but are you sort of looking at some over others, and how do you sort of choose which one's the best stock to buy into?
Yeah, if you look at Afterpay, it's up maybe 16 times since we bought it, but it's basically been doubling every year as well. So the size of the company's kind of tracked the growth in the share price. We did something on Tesla as well, where basically the number of cars of the last 7 years increasing number of cars has also tracked the share price. So these companies getting materially bigger every year. We're here to make money. We're here to try and find things that are going up. So I think if you go to the ones with the strongest revenue growth that are materially bigger every week, month, year, that kind of does help you a lot.
Is there temptation to take profits on things like Tesla and Afterpay at these levels?
It's a tough one. I mean, Afterpay is at the top of its trading range. Tesla I actually think was cheap recently. It was 20 times EBITDA. That's not a sales multiple. It's now 60 times EBITDA, a few months later. But at the same time, the game has changed for them. Like, they've rolled out in Asia very successfully.
Yep.
They're the go-to luxury car now. Everybody you speak to wants to buy a Tesla for the next car, it seems.
So what signal would ever see you take the full profit on a trade? What would you have to see turn around? Would it be a material loss from a company? Would it be a real change in market momentum for you to want to actually unwind some of these trades?
I mean, in my experience, every time I sell something, you generally regret it, especially like a few years down the track, especially these very fast-growing companies.
Yeah.
So yes, I do take profits, and I almost invariably regret it. So something Tesla now, when it's got from 20 times EBITDA to 60 times EBITDA, maybe it's a good time to take a little bit off the table and give yourself a bit of a balance so that you can a cash reserve. So if this growth sell-off continues, you can really buy the companies that we're already identifying, with strong revenue growth that we don't own yet.
Question, given some of the, crisis mode that markets are heading, well, not markets, but the economies are heading into right now with more lockdowns here at home and across the globe, we're seeing virus cases continue to rise. How do you play that as an investor? Because I know you've sort of said, hold your nerve, stay in the stock, stay exposed. Is that still how you'll be playing it as we get a second wave, or if we get a second wave?
Yeah, I mean, I think it's too hard to trade these things. Yeah. I mean, we're getting to the point where this first vaccine readouts will come, within 1 to 2 months. So if one of those comes out positive, that will change everything again. So you can see a world where, we slowly start locking down, stocks continue to sell off, and then one of these announcements comes out of nowhere and rips. So I think this is the time to be long-term and just ride through these kind of moves. That's my take anyway.
Yeah, well, we're interested in your take. That's why we have you on the show.
Absolutely. It's been a pleasure, as always, having you come
Thanks so
onto the
much.
program. Another fantastic investable idea.